Imagine waking up after a string of losses with your heart racing before you even look at the screen. Have you ever let emotion dictate every click, increasing your position size in an attempt to win it all back? That is the phenomenon of revenge trading, when the pain of a loss activates neural circuits that poison your reasoning. In the heat of the moment, our brain becomes a battlefield between the amygdala, the seat of fear, and angran, the prefrontal cortex, which governs planning and discipline. The instant we suffer a loss, dopamine levels plummet and cortisol surges. Instead of reflecting on the mistake and adjusting our parameters, many traders jump into the next trade, seeking immediate relief, repeating the cycle until their account is depleted. Today, I will show how neuroscience explains this anomalous reaction and why simply pushing harder never works. We will dissect real cases of traders whose fortunes evaporated in minutes of fury, identify which brain regions trigger self-destructive behaviors, and learn practical strategies to stop this machinery before it consumes both your capital and your confidence. When we face a sequence of losses, our body immediately recognizes a danger signal, activating the hypothalamic pituitary-adrenal axis and flooding the bloodstream with cortisol, the stress hormone. That same substance that could protect us from a genuine threat becomes a villain in the trading environment, because it impairs communication between the prefrontal cortex, our rational command center, and the amygdala, the emotional core responsible for the fight or flight response. Instead of allowing reason to guide the next decision, the brain reverts to a primitive mode. We find ourselves praying for a quick win to restore the chemical balance recently shattered by losses. Cortisol has a direct effect on memory and attention. At elevated levels, it intensifies loss aversion, making each new drawdown feel more painful than the last and inflating the urgency to recoup losses. It is common for traders, pressured by this hormonal cascade, to ignore their own risk management rules and increase position sizes in an attempt to recover in a single trade what was lost over many. This behavior drastically heightens account volatility and brings the trader closer to irreversible financial collapse. Consider the case of Nick Leeson, the coyote who brought down Barings Bank in 1995. After initial failures in his futures operations, Leeson felt compelled to recoup his losses quickly. As the deficit grew, stress became so overwhelming that he began ignoring all leverage limits and hiding losses in off-balance sheet accounts. Leeson later admitted that under the influence of cortisol and adrenaline, all his mental restraints simply vanished, replaced by a single objective: reverse the losses at any cost. The result was the worst crisis ever suffered by a centuries-old institution, triggered solely because his brain chose immediate reward over disciplined planning. Yet this story is not confined to famous figures. Imagine a retail trader, we'll call Carlos, who entered the market with $20,000 in capital. After 2 days of moderate gains, he was hit by 3 consecutive stopouts. When he realized the third loss, his pulse soared to 120 beats per minute and his hands began to tremble. Instead of stopping, Carlos felt an irrational urgency to get the next one right. He increased his lot size from 5 to 15 contracts, violating his own 2% per trade risk rule. The next order, placed in a fraction of a second, resulted in an even larger loss, wiping out 15 days' worth of gains. The critical error was not the technical setup, but the trader's own chemical state seizing control. Neuroscience confirms that under sustained, intense stress, the prefrontal cortex reduces production of neurotransmitters such as dopamine and acetylcholine, diminishing capacities for planning, self-control, and mental model updating. Meanwhile, the amygdala becomes hyperactive, fueling a cycle of fear and desperate hope: fear of losing more, hope of short-circuiting the learning curve with a single trade. This conflict between two brain systems makes revenge trading so lethal, because no one can maintain lucidity when the body is in emergency mode. To interrupt this mechanism, the first step is to physically recognize stress signals: shallow breathing, sweaty palms, a racing heart. If these reactions appear, the trader must immediately halt trading, step away from the screens, and adopt relaxation techniques such as diaphragmatic breathing or a 5-minute walk. Simply activating the vagus nerve through slow, deliberate breaths reduces circulating cortisol and allows the prefrontal cortex to regain control. The second pillar is to establish a reset protocol within the trading plan. Whenever losses exceed a predetermined daily threshold, 15%, all operations must cease until the next business day. This external barrier serves as a strong behavioral anchor, preventing the trader from relying solely on subjective discipline under high stress. Finally, education on neurochemistry applied to trading becomes crucial. Understanding one's biological triggers allows the brain to be programmed for better volatility tolerance. Mental training sessions, focused meditation, and regular mood control exercises become as fundamental as technical analysis or risk management. When a trader realizes he is not failing for lack of skill but reacting to an overstimulated biological imperative, he gains the power to design strategies that, in practice, break the emotional loss cycle before it even begins. In the next few minutes, we will delve even deeper into how to modulate mental state using evidence-based protocols. You will learn techniques that major hedge fund trading desks apply to keep their operators calm, serene, and disciplined, even amid market storms. The journey to master revenge trading begins within your own brain, and with each insight you take a step closer to transforming your behavior into an unbeatable competitive advantage. When a trader finally secures a profit after a string of losses, the brain experiences a burst of dopamine, the neurotransmitter linked to pleasure and motivation. This chemical surge activates the same reward circuits involved in addictive behaviors, such as drug use or pathological gambling. In that moment, recovering what was lost becomes more than a mere financial strategy. It turns into an emotional survival necessity. Each small victory imprints a persistent memory of relief and comfort, reinforcing the belief that the next recovery trade will be the definitive solution. However, dopamine carries a dangerous side effect. The brain rapidly adapts to these reward peaks, creating tolerance. Just as a substance user needs ever-increasing doses to achieve the same high, the revenge trading trader begins to raise position sizes or pursue increasingly risky setups. He almost unconsciously associates every dollar gained with a sense of security that soothes the residual stress of prior losses. The more desperate the hunt for dopaminergic relief, the deeper the trader descends into the vicious cycle. Consider the case of Laura, a day trader who hit a new high. After swiftly recovering 3 consecutive stops, adrenaline and dopamine fueled her ego. She believed she had discovered a shortcut to success. In a single day, she tripled her initial capital. Yet by neglecting her risk rules, she kept adding contracts to subsequent trades in a near-fanatical attempt to replicate the gain that had validated her. Within minutes, the tide turned, and that flash victory returned to the market with interest and correction. Her balance fell to zero, and Laura lost not only her money but also her confidence and mental clarity. Addiction neuroscience teaches that to break this pattern, one must establish micro-rewards and decouple financial gain from emotional relief. In trading, this means creating extrinsic reinforcement triggers, for example, a ritual of scheduled breaks after each trade, during which the trader stands up, takes a brief walk, or logs not only the result but also his emotional state. This ritual not only releases healthy endorphins through physical movement but also jolts the brain out of the pure dopamine autopilot. Finally, understanding that trading is not a 100-meter sprint but a mental marathon helps redefine dopamine's role. It ceases to be the objective and becomes merely a byproduct of disciplined performance. The more consistent the risk management and self-control routine, the less dependent the trader becomes on chemical highs and lows, and the more capable he is of focusing on the process rather than the immediate reward. In this way, the trap of compulsively chasing gains dissolves, making room for sustainable, truly winning behavior. For the world's top traders, avoiding tilt is not a matter of luck, but the result of disciplined emotional recovery routines. These practices are built into the trading plan as mandatory protocols, as essential as stop losses or position sizing. Let us examine 3 core techniques that separate true professionals from amateurs, still at the mercy of raw emotions. The first and most immediate strategy occurs in the heat of the moment, the anchoring breath. As soon as a trader recognizes a loss beyond a predefined limit, say 1% of capital or 3 consecutive losing trades, they instantly halt any new orders. Standing up, they step away from the screen and practice deep breaths, inhaling through the nose and exhaling through the mouth on a slow count of 4. This technique activates the vagus nerve and lowers heart rate, creating space for the prefrontal cortex to regain control. In market jargon, this is called a chemical reset. The rapid drop in cortisol and the gradual return of oxygen to the brain restore some of the lost clarity. Immediately after this 1 to 3 minute pause, many professionals turn the moment into instant learning. They record not only the numeric outcome of the trade but, more importantly, their emotional state before, during, and after the execution in a journal or digital system. For example, a commodities trader might note, "Before entry, I felt anxiety. Because of an inflation report, my breathing became shallow. Afterward, frustration made me want to repeat the setup with more contracts." This exercise in metacognition, or thinking about one's own thinking, reveals automatic emotional patterns under stress. Over time, the trader learns to identify internal triggers and to anticipate the need for the breathing protocol even before feeling full pressure. Another pillar is the cool-down concept popularized by Mark Douglas in Trading in the Zone. Douglas recommended that upon reaching a drawdown beyond a critical threshold, for instance, 3% of capital, or 3 consecutive losing days, a trader suspend all market activity for 1 or 2 business days. This is not punishment but a mental quarantine. During this period, the trader does not read financial news, monitor quotes, or revisit charts. The goal is to let the brain process emotions at a distance. without external stimuli that fuel further stress. Elite hedge fund professionals apply variations of this idea on a larger scale. Programmed weeks off after intense volatility cycles or reduced trading hours during periods of high macroeconomic uncertainty. This strategic rest prevents emotional fatigue from accumulating and triggering severe tilt episodes. Beyond individual techniques, many elite traders employ a human check-in system shared accountability. They maintain daily or weekly contact with a coach, deskmate, or mentor, sending brief reports of performance and mental state. If the mentor detects high-stress weather via trading metrics, number of trades, sudden changes in position size, or subjective mood reports, they can recommend an immediate forced break. This social element creates a reputational cost to giving in to tilt, because the trader knows someone is watching and will question impulsive decisions. Social accountability and a sense of commitment boost resistance to emotionally driven trading impulses. Integrating these practices requires discipline not to underestimate them. At first, it may feel excessive to pause trading after a single unsuccessful trade. However, consistent use of these protocols builds mental conditioning. The trader teaches their brain to associate losses not with a frantic recovery sprint, but with a controlled sequence of self-awareness and rest. To implement effectively, follow this minimum roadmap. Define clear triggers. Establish the drawdown percentage or number of consecutive losses that activate the protocol. Immediate breath anchoring. Perform 3 slow count breath cycles before placing any new orders. Logging. Record your emotional state and context for each trade in your trading journal. Structured cool. Schedule 1 to 2 day breaks after critical triggers in your calendar. External check-in. Share weekly reports with a mentor or deskmate. By adopting this emotional recovery system, you stop treating trading as a solitary test of courage and start treating it as a coordinated process of peak mental performance. The result is an extra layer of emotional protection that keeps your prefrontal cortex fully operational even under intense volatility. In the next chapter, we will explore how to reinforce this control with mindfulness, training protocols, and mental state exercises used by the most consistent traders on the planet. In poker, the term tilt describes the moment when a player loses emotional control and begins making erratic decisions driven by frustration and anger. In trading, exactly the same phenomenon occurs. A sequence of losses or an unexpected drawdown traps the trader in an emotional loop that shuts down the prefrontal cortex, our center for planning, self-control, and rational decision-making, and overactivates the amygdala, accelerating the cycle of visceral reactions. When the prefrontal cortex is overwhelmed by stress, its capacity to evaluate probabilities, review plans, and adhere to risk rules evaporates in seconds. In its place, the brain switches to autopilot, seeking quick fixes to ease emotional pain. This is when the classic signs of tilt appear. Abrupt increases in position size, ignoring stop-loss levels, executing trades outside the original plan, and repeating poorly grounded entry patterns. Consider the example of Miguel, a disciplined swing trader who normally kept only 2 positions open at a time and respected a maximum risk of 1% per trade. On a volatile day, an unfavorable gap closed one of his trades at the stop. Contrary to his process, Miguel felt a tightness in his chest and an almost uncontrollable urge to open an even larger position immediately. In order to erase that mistake, instead of seeking a setup aligned with his plan, he disregarded his chosen timeframe and bought leverage that he had never back-tested. The result was a 3% drawdown in minutes, propelling him into a spiral of impulsive trades until he ended the day with the largest monthly loss of his career. Neuroscientifically, this behavior is linked to reduced glucose levels in the prefrontal cortex, which consumes 20 to 25% of the brain's energy. Under stress, metabolic demand exceeds supply, and prefrontal cells enter functional hibernation while the amygdala and limbic system remain hyperactive. The trader then perceives new trades not as choices but as urgency, almost survival instincts, promising to restore emotional control. Furthermore, sustained stress leads to the phenomenon of amygdala hijack, where the amygdala acts as the sole command center, eliminating the logical brake of the cortex. In poker, the absence of that brake leads players to go all in on marginal hands. In financial markets, it translates into hammering market orders, ignoring stops, and trading without criteria, multiplying errors until the chemical imbalance subsides or the account is wiped out. To avoid tilt, the first effective strategy is meta-control, training the brain to monitor physiological signals that betray emergency mode activation. This includes immediately noticing when breathing becomes shallow, facial muscles tense, or the gaze fixates and speeds up. Developing this somatic awareness is as vital as learning to draw trend lines. A practical tactic used by professional quant fund traders is the 3-second rule. Upon feeling the urge to re-enter the market immediately after a loss, the trader must close their eyes and count slowly from 1 to 3 before taking any action. This simple pause slows the amygdala's impulse, gives the prefrontal cortex time to react, and returns the trader to an observer's mindset before making a decision. Another powerful barrier is the programmed tilt break in the risk plan. Include a clear trigger, such as if more than 3 consecutive losing trades occur at any point during the day. I will close out positions and take a 15-minute break away from the screen. This rule creates an external anchor that sustains self-control when internal discipline fails. It mirrors the poker player's time out to cool off before returning to the table, in parallel. Neural reset training techniques, such as focused meditation and mindfulness exercises, gradually rewire connections between the prefrontal cortex and the amygdala. Studies show that regular meditation practitioners can reduce amygdala reactivity to stress stimuli by up to 30%, preserving logical reasoning even under intense pressure. A simple protocol involves dedicating 5 minutes before each trading session to breathing exercises and body scanning, slowing limbic activity, and reinforcing rational control. Finally, establishing checks and balances in the trading system. Periodic reviews with a coach or desk partner ensures the trader is not alone in deciding when to stop. Sharing responsibility and having someone validate rule adherence increases social accountability and raises the psychological cost of succumbing to tilt. When the trader knows their metrics and decisions will be reviewed, the amygdala hesitates to seize full control. By integrating these applied neuroscience strategies, you transform tilt from an unpredictable threat into a manageable event. The brain ceases to be a hidden enemy and becomes an ally trained to act rationally even in the heat of battle. Ready to move forward and explore how to consolidate this mental consistency in long-term trades. In the next chapter, we will dissect the molecular risk management techniques that top asset managers use to protect capital and sleep soundly every night. To conclude our deep dive into the neuroscience of trading, let us build an anti-revenge brain, a mental conditioning that views losses not as wounds to be immediately cauterized, but as neutral data to be analyzed with calm. Here is a practical, step-by-step protocol tested by professional traders at investment banks and hedge funds to reduce pre-market anxiety, maintain control during trading, and ensure that every click is validated by reason before any emotional impulse. 1. Pre-market routine, programming the ideal state before even powering up your screens. Devote at least 15 minutes to a structured ritual that soothes your neural circuits. Begin with a 5-minute guided meditation, focusing solely on the sensation of breath entering and leaving your body. This simple exercise lowers circulating cortisol and activates the prefrontal cortex's attention network. Next, write in your journal 3 clear intentions for the day, not profit targets, but desired behaviors. For example, approach each trade with curiosity, or accept every loss within limits without seeking immediate compensation. Finally, scan the day's key macro events, jobs reports, rate decisions, earnings releases to anticipate volatility without diving into charts, so you start with a clean view of what to expect. 2. Hard daily trade. Limit. A well-rested brain is a more rational brain. Establish a maximum number of trades before you make your first, 5, 7, or 10, depending on your style. Once that limit is reached, seize any new entries, regardless of setup. This cap acts as an external guardrail, preventing desperate recovery attempts when the market turns. If the limit is hit in losses, immediately apply Mark Douglas's one-day. If hit in profits, celebrate moderately and pause until the next trading day, ensuring dopamine does not become the main course. 3. Mental checklist. Before every trade, abandon the obsession with perfect setups and focus first on your internal state. Before clicking buy or sell, run through these 3 questions. How is my breathing? If it feels shallow or rapid, take 3 deep, slow breaths before proceeding. What is my level of urgency? If you feel any urge to correct a loss or seize an opportunity, stop and ask yourself, am I trading by logic or by emotional relief? Am I present or distracted? If your mind drifts to your phone, news, or unrelated thoughts, return to 0, pause, and resolve the distraction before restarting the checklist. Only when all 3 answers indicate balance, calm breath, 0 urgency, and focused mind should you evaluate the technical setup and decide on entry. 4. Post-trade. Anchoring. Closing emotional loop. Stern. The closing of each trade into a ceremonial conclusion, not merely a transition. After every exit, open your journal and record in 2 lines the quantitative result and your dominant emotional state. No lengthy essay is needed. Simple. 1R. Felt fear of early stop or +2R. Felt confidence and clarity suffices. This habit teaches your brain to separate the approved process followed from the disapproved, reactive trading, neurologically reinforcing patterns of calm and control. 5. Weekly review of emotional patterns. At week's end, set aside 30 minutes to review your emotional journal. Look for recurring patterns, times of day prone to anxiety, types of setups that trigger revenge impulses, or macro events that most affect your state. Based on these insights, adjust your pre-market routine or trade limit to mitigate these vulnerabilities in the week ahead. By following this sequence: meditative pre-market, strict trade limit, emotional checklist, post-trade ritual, and weekly review, you train your brain to view losses not as urgent wounds but as valuable, neutral information. The ultimate competitive edge arises from emotional mastery, and this habit structure forges your mental state into an impenetrable armor against the self-destructive cycle of revenge trading. In the next and final chapter, we will explore how to consolidate this winning mindset into position and swing trading strategies, where emotional patience is as critical as technical timing. Prepare to elevate your performance with protocols that unite market intelligence and psychological resilience. We have reached the crucial point of this journey. Your greatest adversary will never be the chart, the spread, or volatility. It is your own brain, wired with ancestral circuits that favor visceral reaction over reason. When you understand that, the market doesn't punish you, your brain does. Everything changes. Losses cease to be catastrophic events and become mere data drama-free inputs that lay the groundwork for refining your decision-making process. True consistency in trading is born from the ability to interrupt emotional autopilot. Every time you take a deep breath before clicking buy or sell, every time you honor Mark Douglas's cooldown, every time you honestly record in your journal what you felt, you strengthen new neural connections that replace the impulse for revenge with a calm, observing state. This daily ritual builds, brick by brick, a psychological armor that makes price direction irrelevant, because you remain aligned with your process. Remember, there is no friendly market or hostile market. There is only a mirror of your mental state. If you react with fury or desperation, you will be lashed by the very emotions you vowed to ignore. But if you treat each loss as a step in your learning, apply the emotional checklist before every trade, and allow yourself to pause when your body cries enough, you become invulnerable to revenge trading. It is this internal discipline that separates traders who merely survive from those who sustain consistent profits for decades. Now, seize this moment of clarity. Comment below, "I will stop chasing losses today," to declare your commitment to self-control and resilience. Subscribe to the channel so you won't miss the next chapters, where we'll explore how to extend this winning mindset into position trading and swing trading strategies. Your next trade may lose money, but with every step you'll be strengthening what truly matters: your brain trained to thrive in an unpredictable market.